Good news and bad news. What would you want to hear first? We're going to talk about that on today's show. We're going to talk about some of the bad news in our fantasy football elimination pool, as well as some signs the consumer is experiencing some bad news. And then we're going to get into some more interesting predictions on what the Fed is going to do tomorrow. But as we get started, this is a financial education presentation. You must do your own due diligence on anything that you hear in this presentation. More disclaimer information can be found on ankerstarwealth.com, and the opinions expressed are mine and Corey's alone. So I know that several of our clients, friends, family members got involved in our different type of fantasy football league, which is just pick a team. If you're the lowest scoring team, you're out. And we want to tie that into at least somewhat of a financial education. So when it comes to managing your portfolio, sometimes you can put all your eggs in one basket and you can be out if you pick the wrong eggs. And sometimes, as we're going to see in today's example, you can pick some funds, stocks, ETFs that underperform. And if you get enough underperformance, I mean, you want to have diversification, but if you get enough underperformance across the board, you could be certainly disappointed with your retirement or savings. And that's certainly one of the goals that we want to, we as professional investors want to make sure that we don't do that. We want to have overperformance. So what we're going to look at today, Corey, and I know you did not get in because you couldn't take the stress of being eliminated, right?
It wouldn't be fair. I don't
Oh, it
watch
would be fair.
I don't watch the NFL.
Well, we'll call it out.
It wouldn't be fair
Your
to
Texas
everybody
A
else on the West
your
Coast.
Texas A&M team won big over the weekend, or so they're doing
See,
good.
yeah, and you think I could have woken up and taken more football after all that stress? No,
I was looking at, if you're a college football fan, so Corey went to Texas A&M, they're undefeated. David went to Texas Tech, they're undefeated. Steve went to Iowa State, they're 4-0 undefeated. I went to Ohio State, undefeated. Jaden, Texas, sorry, they played Ohio State, so they had to go down. So, and I don't think Kansas is doing too good with Wisconsin. But we do have some fun themes around this office. So let me take a look. And this is the first, a good friend of ours, Pam. We will not say last names. We will not dox you on your fantasy football. But Pam, is our next person to be eliminated. And when we look at the stats for her team, Kyler Murray, Nico Collins, Brian Thomas, I mean, she had 7 people, none of which are bad. I'm fine with all 7, but all 7 underperformed this week. They were all below what they were projected, and that means Pam has been eliminated. So I'm sorry, Pam. We'll catch up. We'll do lunch one of these days, and you can drown your food in tears from this loss. The Ankerstar Silver Bowl will not be sent to Pam this year. Our other elimination, I see some of the same names, Nico Collins, Brian Thomas, but then Justin Fields, who is an Ohio State quarterback, absolutely atrocious. He only had one person. This is Brenton's team. So Brenton, you probably don't get called out on the show a lot. The Sacco team has been eliminated. So these are just for fun. So every Tuesday, I will have our elimination update. It will get more intense as it goes on. Steve and I both have our teams, so we'll see who can knock us off.
who's still
Okay.
in? I want to see kind of what we're working with.
What do you want
Certainly
to see?
wish everyone well who is no longer with us.
Yes. And if I go to the standings, this is in the West region. So you can see what happens is now there's 13 teams left, and they kind of project out that Star Move Rage, Magic Move Trail. They're on the bubble, and then
Okay.
Math Mania, is the highest projected for next week. But that doesn't mean there's
Wait,
not upsets.
I'm going to endorse a team, Mike, for the remainder of the season, but I need to see a roster. Can I get
You can look at
no
that later.
regret? Huh?
You want no regret? No
Well,
regrets?
I want to see the roster.
Okay, we'll take a look at this. I'm
Let
not
me
even sure
see.
whose team this is. Whose team is this?
You know what? I'm going
Patrick
to endorse no
Mahomes.
regret. I've got
You're
no
taking.
regrets.
I know. I noticed you didn't take Jaden's team or my team or Steve's team, but
Well, that'd
okay.
be too much home cooking. But no, I'm endorsing no regrets.
Okay. So taking no regrets. So some regrets that some people have is
Okay.
they bought a new car and they pay it down over a long period of time. Let's just say 7 years would be kind of a longer loan term, maybe 8 years. I mean, those are long loan terms. And what happens is when you drive that car off the lot, a brand new car, it depreciates pretty fast right away in the first 5 minutes you drive it off the lot. But then eventually, the car, you make payments, and eventually you owe less on your car than it's worth. And that means you're above water. But until that happens, you're underwater. So when you owe more on your car than it's worth, and when this appears is when you go to trade in your car to get another one. And my wife works in this industry, and they tell you, yeah, you're trading in your other car, but to even get this loan, you're going to have to put 2 or 3,000 more down or whatever that is. So those are underwater car trade-ins. Most likely it happens when you buy a new car. That's when it most likely to happen. It could happen when you buy a used car as well, but more likely on the new. Underwater car trade-ins are at a 4-year high. So what does this mean? And like I said, my wife works in this business, and it impacts buying a new car. Someone comes in, I'm real excited. I want to buy a brand new car. I want to consume. I want to spend money to get this new vehicle. I'm excited about it. And sometimes they get kind of cold water thrown in on that goal. It might be not that bad if it's 1,000 or 2,000, but if they find out that they are 10,000 in the hole, they might not be able to get approved, nor maybe should they be approved to get that new car. So I saw this article, thought I'd point this out. One thing that I've seen in the past, and I'm not going to, I've bought new cars in the past. I bought used cars. I think I saw from a financial perspective, the absolute best way financially to buy cars is to buy them at 5 years old and sell them at 10. So a 5-year-old car has had a lot of depreciation, but it's still in pretty good shape. At 10 years old, that's when you start to get a lot of maintenance issues. How about you, Corey? What's your experience buying cars? What do you think?
Man, we just bought a new one this year. Pretty depressing, but we do use you pay cash and just move on.
Yeah.
So,
Yep.
but I like your strategy. Buy at 5 and sell at 10. That's smart, Mike.
Yeah. Now I can't say that I always follow that strategy, but that's something, and it's not even, it's not my strategy. I read it is the financially best way to deal with cars.
Yeah.
I typically have been buy a new car and drive it till it dies person.
Yeah.
So I've had cars, like my current car is 6 years old. And I have every intention to keep it for another 6. So, and I've had cars for over 10 years before. So that's my strategy. But I will admit that, one, I haven't tried to trade it in, so to be underwater. But at the end, since I'm driving it till it dies, those last few months before it dies, it gets expensive. You have to make these decisions where they say it's going to be $500 to fix this thing. And you're like, if I can just get like 2 more months out of it, it's worth that 500. But when that starts to add up, it's kind of painful.
Yeah, that's tough. And then usually one thing breaks, and then you get it's like a domino effect at some point.
So and managing your money, managing your wealth is a part of it. And the thought is, hey, if you manage your car purchasing, maybe you'll have more money to invest, which is really where our expertise is. And then one other, no regrets or regrets. And this is another side, and this leads into Corey's discussion on rate cuts, is we're seeing credit scores fall for the second year in a row as more borrowers miss payments. Some of this can be related to student loans, students having to start paying those things back, where they were kind of waived for a while. But and it's not a big number. The average, and I kind of saw this, the average credit score is now 715, down from 717, down from 718. So I mean, it's gradually declining. I don't know if that's statistically a big trend yet. I mean, to me, it's probably almost a flat line. But when it comes to credit scores, they are not looking at your income in any way. They are only looking at your ability to repay debt, houses, cars, credit cards, student loans, and there's probably a few others out there as well. That's the key. Make $1 million, pay your loans back late, you're gonna have a low credit score.
Mike, I was surprised how high these are. These are high.
Yeah, I think. Boy, my wife would tell me from like when people get auto loans.
Yeah.
I know anything. I've always heard anything over 800 is excellent, and probably 700 to 800 is good. I don't remember the exact brackets. And then you start getting down below 550, like you're probably not going to get a loan for anything.
Sure.
So and I will say that when it comes to credit or FICO score repair, you want to pay off your bad debts, or you want to get them taken off your credit score, and make consistent payments. So I just thought I would hit on that, because when I see things like credit scores going down, auto loans, if I see the 90-day delinquency rate for credit cards going up, these are all signs the economy's slowing, consumers are getting squeezed. These are just signs towards a breaking point, which would make sense for the Fed to lower rates. Corey, we've been hearing about it for 6 months. Fed lower rates, too slow. Is tomorrow the day?
Tomorrow is the day, and tomorrow is relatively certain at this point. You've got a 96% chance of a 25 basis point cut. You can see we're right at about 4.25 to 4.5% currently, and expect to be 25 basis points lower than that, tomorrow afternoon. There's a 4% chance at a 50 basis point cut. So I do want to highlight this. I looked at some data yesterday. Well, I was presented some data yesterday from Data Trek Research, and give them full credit for this research. But they show that you don't really want the Fed to need 50 basis point cuts, because if the Fed needs 50 basis point cuts, things are changing rapidly, and usually for the wrong reasons. So you got some 50 basis point cut in 2020, along with 75 to 100 basis point cut. You got one in 2024. That one worked out okay.
I think on that one, the one in 2024 last year, they just pulled the trigger a little too early on that. The market didn't panic, and it was kind of like, I think in hindsight they were probably like, yeah, we should have spread that out.
And the 2022 hiking cycle was like one of the fastest, or if not the fastest in history. So a little bit of unwind there, and it made sense. So it worked out. But 2007, 2008, if the Fed needs a bunch of 50s, that's not very good. 2001, 2002, if the Fed needs a bunch of 50s, that did not work out very well. And then the early 90s, you had a few, and then you did have a little recession there in 1994, if I'm remembering correctly, but which resolved much higher in the late 90s there. So more desirable is kind of a slow and steady 2019, just some 25 basis point cuts that are projected, and slow and steady. If we go out a year, so we go to September of 2026, we're looking at projections currently of that federal funds rate being right there at 3%, which seems reasonable if you're having some small concerns over labor, employment, and you're not really having runaway inflation. So anyway, Mike, that's what I've got.
Yep.
Tomorrow's the day. I bet there's some realtors out there like Christmas, and they're just holding
I don't
on.
know. I don't know if it's that exciting. I think this is going to be kind of anticlimactic. Of course, let's say the Fed lowers it a quarter. What people are really going to be looking into is the language they talk about.
Yep.
Like Corey said, is 96%. It's kind of like, I think we know who's going to win that game. It's going to be a quarter point. If we see a 50-point cut, that means the Fed says, wow, this economy's sinking quick, and the market
Right.
could sell off on that.
Right.
But what Corey's looking at a year from now says, hey, the rates come down, house mortgage rates come down too at some point. And that one's tied closer to like a 2-year or a 10-year treasury note. So
Yeah, I actually had that pulled up, and yeah, that 10-year has fallen fast in anticipation of this rate cut cycle that we're starting tomorrow.
Yep. So I don't know if we'll be on tomorrow before the rate cut or after, or we'll be talking about it on Thursday, but really it's the language. I don't know we don't know what the market's going to do, but if you look at, I think it typically comes out at 2:00 Eastern, you could see the market gyrate. It might go up, down, it might react to something. But in the long run, we're all in it for the long term. So we're not trading anything in the short term. So with that, thanks everybody for hopping on. Have a good one.